Whenever we say equity analysis or equity research, okay, people say that there are two schools of thoughts. One is fundamental analysis, another is technical analysis. You are here for technical analysis, I know. Then why to talk about fundamentals? Because you will understand technical analysis once you understand fundamental analysis and at least the basics of it. Please watch this space here and try and understand what we do when we do fundamental analysis. At the end, why are we analyzing an equity stock? Or why are we analyzing the market? What is the reason? We all want to either buy or we all want to either sell our investments, which means that if it is the right time to enter the markets, I should be knowing that. If it is the right time to sell off my stocks, I should be knowing that. Basically, portfolio management, wealth management, investment advisory, financial planning. At the end, mutual funds, all of these, they perform if they know the markets well. Now, when to buy and when to sell is basically understandable when we get into the fundamentals properly. Okay. Now, you need a lot of brain and the knowledge of accountancy and the knowledge of accounting ratios, as well as understanding in an in-depth way the financial statements of a company, as well as have some news or subscriptions which give you news way in advance than the market comes to know about those news. Only then you can really make use of fundamental analysis. They say that the funda of fundamental analysis makes you mental. That's why fundamental. So it is a lot of brain power which is used in fundamental analysis. Okay. Now, when we are analyzing a stock, we try to find out about the company first. Okay. Which means what is the company doing? Which business is the company in? That's the first thing which we see, isn't it? Which business the company is doing. Then we look at the board of directors. We look at their history. We look at their present performance. We look at the composition of the board. Then we look at the other management and the key personnels, who is heading the company, who is heading each and every department. Then we do some sector and industry analysis to understand that if this company has some kind of pure competition, it has a monopoly, it is into an oligopoly, which form of market competition they are into. Then we do a research of the products and the services the company is providing. Then we talk to the customers and get some reviews and understand whether the company is actually making products which in the long run will help the company to make a good profits. Then we kind of predict the sales and the profit growth in the company. Okay, it is said that if a company can have a sales growth of 20 to 30% in a year, its profit will actually double, because a small impact on the sale can lead to a big impact on the profit because of fixed costs. Okay, this is called leverage. All right. Now comes the main thing, the annual report. Okay, the annual report consists of all information you need to do fundamental analysis of a company, which means that we are going to look at the financial statements of the company. We are going to look at the director's report, the auditor's report, the future prospects, the growth of the company, and a lot of other things which are there in the annual report. Now, we all know that understanding the profit and loss statement, which is income statement, and understanding the balance sheet is not a joke. You need to study a lot to analyze these things properly. There are various financial tools available, but still, when you analyze the financial statements, you have to do calculations of some accounting ratios. Some ratios are readily available, some ratios you have to calculate, and then you will be in a position to do financial modeling of the company. When you do financial modeling of the company, you are essentially trying to predict where the company will go in the future. Apart from that, what you need to do is also another thing is valuation. Okay, valuation of the company, to understand whether the company right now is undervalued or overvalued. So some people look at the price to earning ratio. Some people look at the price to book value ratio. Okay, if the earnings is this much, what should be the price? If the book value of the company is this much, what should be the price? Right? Valuation techniques are like dividend discount model, okay, DCF model, free cash flow model, right? Asset-based valuation, liquidation valuation. There are various other types of valuation models you can apply. All of this is done generally by CFAs or CAs and those who have done some kind of course relating to corporate finance. those people can actually get into all of this and learn and kind of then finally arrive at a decision. But a very important role here is also of the news, which means that they say in the markets that suppose if a company's factory, one of the factories burnt, even before the fire brigade is informed, the market is informed, which means that even before the company is understanding what exactly has happened, they will see that the share prices in the market have already started falling. If out of 10 factories, 2 factories have caught fire, they will say that, see that the share price will drop by or crash by a few percentage of rupee. Okay. Now that percentage of crash in the stock price has been a calculated estimation of people as to that if the 2 factories out of 10 factories are burned, how much sales will be lost. Basis that, how much earnings will be lost, how much profits will be lost. Basis that, what should be the new valuation of the company, and based on that, what should be the new price of the company. So at the end, we are all kind of predicting the price, right? So they say that price of a stock, it involves, it includes, it imbibes within itself every possible news which is either there in the public domain and which is not even there in the public domain, but it is due to come in the public domain in maybe in some minutes or some hours or some days or weeks or months. Okay, news play a very important role. Valuation models play a very important role. All these qualitative factors also play a very important role, and all these quantitative factors also play a very important role in fundamental analysis. But did you realize one thing? At the end, whoever is doing the analysis will recommend either of these two: buy oblique. Let's say if the thing is underpriced and you're holding it, then you can hold it. And if it is overpriced, then they will say exit the stock or sell it, let's say. That's what they are going to do, which means at the end, their also focus is on the price. If you have looked at the P ratios formula once, the P ratio formula includes the market price per share divided by earning per share. What does it mean? It means that the earnings are taken from the balance sheet, but the market price is taken from the stock markets, and it is always the latest figure. The market price is the latest figure, but the earning is of the last year, or the earning is calculated based on quarterly results of the company, which are not even audited. So they are not 100% reliable. A lot of adjustments and I would say window dressing happens there. So even the PE ratio relies upon the market price per share. So at the end, whatever is a good news relating to a company or a bad news, the effect of that comes down to the price of the stock. Also, suppose if you are one of the insiders, even though insider trading is banned, okay, it's not allowed, it's penalizable. But still, if you are an insider of a company, you are close to the management, you are one of the auditors, you are one of the key employees of the company who have some knowledge about the company which others don't have, you can use that information and buy the stock in the markets before that news will be publicly available, and the stock will start reacting to the news from the overall perspective, right? Before that, you can make use of that news. So a lot of people say that why suddenly a stock goes up without any news, without any information about the company, suddenly the stock has gone up. So the answer to that is some insider was aware of what news is about to come, and that's why they informed others who are close to them, and they all started accumulating the stock. So a lot of accumulation started happening in the stock, but the news has still not been disclosed or announced in the public domain. And maybe sooner or later you'll see that when the news comes, before that every price action which has already happened, now nothing is left. I mean, even before the news comes, people predict and they react to everything. Okay, what will the COVID virus do to our Indian economy has already been discounted in the news, in the price of the stocks. Okay, discounted means the effect of that has already come. It's not a discount or a minus or a negative thing. I'm saying discounted would mean that the effect has already come in this thing, which somewhere when we travel, let's say I'm going to the airport and someone said that there's a lot of traffic jam today. So I'll say, okay, I will discount that thing in my calculation when I'm going to the airport and when I'm going to leave from my office, let's say, or from my house. So discounting means taking into consideration. So the price takes into consideration all the latest action. In fact, some people say that the sales figures, the profit, the annual report, the quarterly reports are way too primitive and old. I mean, I'm buying a stock today. Wow, what will I do by knowing where the company was 1 year back? Okay, so basically the data of fundamental analysis, the raw material, number one, is too old. Okay, too much qualitative information is there which cannot be converted into monetary terms easily. Plus, number two, you would also require some insider knowledge, etc., to beat the markets. Now, the information relating to fundamental analysis, which can really help you to make money in the long run, is either you have to stick with the investment for 10, 15, 20 years if you have that much time, or if you have some insider information, it can help you to make some quick money, which is a very classified information. Okay, I mean, out of 130 crore people, only a handful of them, you can count on your fingers, would know really about the company. Okay, and they would never tell it to anyone. However, once an insider knows that there is an information about the company which is, let's say, positive, with which the stock should be going up in the coming time, so what will the insiders start doing? They will start accumulating the stock on that positive news, but they'll not tell it to anyone. Now the insider will buy the stock through one of his brokers, right? Now if the broker sees that the management, or let's say a relative of the director of the company, is accumulating a stock, and he knows that after 3 days the quarterly results are going to come, then it's a welcome news for the broker. So the broker will start releasing tips in the market to all his clients that you can buy the stock. Why? Because the insider is buying. He will not disclose any other information, but he will say, just buy the stock, don't think about anything. So everyone will start buying the stock, okay, based on the estimated news. And then when the actual news will come, people will start booking their profits and the stock will go down. And that is the reason mostly what happens is, after the actual news comes, it is too stale, it's too old for the market to react. In fact, by that time, the markets have already discounted that news, and now the stock will actually come down because the people will start booking their profits now. I mean, those who wanted short-term gains, right?